Welcome all. We are here at our first of the year DPN Conversation on green finance. This is a policy briefing on what state leaders can do to ensure that their state's financial policies, regulations, and institutions best mitigate climate change and support green energy transitions. I'm very excited about this conversation because the cause of tackling climate change is not a cause that's like other causes where it's just one thing among many. It is such a large cause and such a large movement is necessary that it needs to have an angle in every single institution of our society. We need to think about climate change in health. We need to think about climate change in education. We need to think about climate change in infrastructure. And this is one of those examples, which is thinking about climate change and finance. What's very special about green finance is it's something that's not only the federal government that can have an impact on this. There can be much that state governments can do. And we have three experts here today. Jordan Haedtler, a former legislative staffer for the U.S. House Financial Services Committee and co-author of a great piece, State and Local Government and the Formation of Green Banks. I'm sure very much interested to all of you. We have Natalia Renta here, a senior policy counsel for corporate governance and power with Americans for Financial Reform. And we have Brett Fleishman, who is on the ground as a senior climate strategist for a county, Boulder County, Colorado, which is one of the vanguard counties on green finance. So without further ado, I'm going to throw it over to Jordan. And just last thing I want the audience to know, as you have questions, raise them up in the chat. And at the end of each speaker, we are going to have a little bit of Q&A. So as the event goes throughout, and the speakers are going to be in there in the chat too, reading your back comments when they're not speaking to be able to answer questions as well if we don't get to them. So over to you, Jordan.
Thanks, Pete, for that introduction. So just a little bit more about who I am. As Pete mentioned, I spent the last several years working in Congress, and during my time as a staffer on the House Financial Services Committee, I helped oversee the development of a climate risk supervision framework by the federal banking agencies. And then last summer, I left my job and I started a new organization that's dedicated to kind of taking that framework and applying it to the state legislative context. And also, as Pete mentioned, increasingly, climate is being conceived of and understood not just as a environmental crisis, but as a issue that's really affecting the economy in a very real way. And it's starting to be understood as a sort of pocketbook issue for your constituents. And so I'm going to talk to you today about how to shield your constituents from climate chaos and the ways that it's affecting overall financial stability and household finances. And so I'll start with, can you all see my screen? Okay, good. So I'll start with just a very brief Climate Finance 101. So in financial regulation, climate-related financial risks are generally conceived of in two broad buckets. And the losses that accrue in these respective buckets end up affecting households, businesses, and in turn spreading to the financial system through banks, insurance companies, asset managers, and other financial institutions. And these buckets are thought of as physical risks and transition risks. So physical risks are costs and damages resulting from floods, wildfires, drought, and other climate disasters. And transition risks are defined as the results of policy action taken to transition the economy to a clean energy economy and away from fossil fuels. And this is usually conceived of as sort of the concept of stranded assets, that is, outstanding loans to fossil fuel companies that are based on an expectation of future profits that can't possibly come to pass if we align our financing with the requirements of a 1.5C future. But I like to sort of think about it as even broader than that. Regardless of whether governments align banks' financing with a 1.5C future, transition risks can be conceived of as manifesting themselves through a rapid shift in consumer preferences. People are going to start using fossil fuels less and less as they see the impacts of climate disasters wreaking havoc on their communities, and also a rapid shift in technological changes that could drop the value of fossil fuels more quickly than expected. And both of these risks have implications for state budgets. You'll see the image on the left is from a recent Pew report that outlined how states are facing dramatic rising costs from the impact of wildfires. And then the image on the left, on the right, is from an early 2021 outlook on how state budgets were recovering from the COVID-19 pandemic. In March 2020, there were $1 trillion budget shortfalls that thankfully mostly didn't come to pass, in large part because of the American Rescue Plan's federal assistance to state and local governments. But there were some states that did experience really significant shortfalls, and those were disproportionately states that were dependent on fossil fuel revenue. So since coming into office, President Biden has started to look at climate as a federal threat to overall financial stability. And in May of 2021, he issued an executive order directing the Financial Stability Oversight Council, which is FSOC, which is a body of financial regulators created through Dodd-Frank, to study climate as a risk to the financial system. That report came out in October of 2021 and found that climate is an increasing and emerging threat to financial stability. And since then, a host of agencies, the Department of Labor, SEC, Federal Reserve, and others have started to put a climate financial regulatory framework into place. But we now see with this federal, with both Congress and the Biden administration beginning to take climate action and climate financial action, the shift is really going to go to the states. And there's several reasons why. In part because the Inflation Reduction Act left so much implementation to state and local governments.
Are other people seeing that Jordan is frozen?
Yes.
Yes. Okay. We'll get in contact with Jordan. And if this lasts more than a minute, we're going to throw it to Natalia. But let's see.
And any of you,
Jordan, we missed the last minute with you. It froze. So we have states or critical battlegrounds in the years ahead.
Oh, okay. Sorry. When you see the presentation, you're looking at you can see my full screen, right? You're not just seeing you're seeing.
Yes.
Okay, cool. Well, sorry about that. So anyway, I was explaining that the imperative for climate and climate financial action is really shifting to the states. And in part, this is because the infrastructure packages that the last Congress approved have a lot of implementation measures, including green banks, which you'll hear more from Brett about. But also because we have divided government in Washington, and anyone who watched the State of the Union last night could probably tell you that there's going to be a lot of dysfunction and state governments have to pick up the slack. And so I wanted to briefly touch on how the actions that President Biden and Congress have taken over the last 2 years have provoked a major backlash. Over the past 2 years, there's been a very forceful campaign organized mostly by the fossil fuel industry, to frame socially responsible investing, or ESG investing, as woke capitalism. And we've seen 7 states enact some form of model legislation restricting ESG considerations, or prohibiting state governments from doing business with financial institutions that use ESG analysis or supposedly boycott fossil fuels. There have been over 90 bills along these lines introduced in 23 states just since the 1st of January of this year. If you're in a state where legislation like this has been introduced, please get in touch. We'd like to help you organize opposition to it. But I'm going to let Natalia tell you more about that, because I want to focus on what states can do to strengthen rather than weaken their exposure to climate risks. And here's just a brief map to show you that states that are doing something about climate financial action really lag behind the backlash that I just mentioned. Maryland enacted a law last year requiring the state comptroller to conduct a climate risk assessment of Maryland's investment portfolio. And with the exception of a few other bills that have been proposed in a handful of places, that's really kind of it. So there's a lot of work to be done. And I'm going to focus on an issue that is largely the domain of state policymakers, and that's insurance policy. And insurance is one of the main channels through which climate risk, is transmitted to the financial system. And this is mostly because insurance companies are hugely exposed to those physical risks that I mentioned. And there are, there was a 2019 paper about this that was written by 2 financial stability experts who are now serving in the Biden administration. And they highlighted a Category 5 hurricane that hit Florida in 1992. It caused over $15 billion of damage and caused the failure of several small insurers. And they told this sort of cautionary tale because there's much more interconnectedness between large insurance companies today and the banking system than there was in 1992. There's also significantly more climate risk, obviously. That's why the Federal Insurance Office in October asked insurance companies to begin collecting and disseminating data about their exposure to climate risk. And that was something that grew out of the FSOC report that I mentioned earlier. But the Federal Insurance Office and federal policymakers in general really can't do a whole lot more than just collect that data, because there is broad federal preemption against setting insurance regulations at the federal level. That job mostly falls to state insurance commissioners and state legislators. So what are we seeing in terms of climate risk and the enormous pressures that it's placing on the housing market and the chaos that's wreaking for consumers and homeowners? We're seeing premium spikes. In New Mexico, wildfire risk caused home insurance rates to increase by 13% last year, and rates went up by an even higher percentage in other wildfire-prone states like Idaho and in flood-prone states like South Carolina. In Santa Clarita, California, some homeowners saw insurance rates go up by as much as 1,000% over 3 years. We're seeing in major markets in Southern California because of wildfire risk, and they notified over 10,000 customers that they would not be renewing their policies last year. We're seeing denials, delays, and underpayments. So when Hurricane Ida hit Louisiana in 2021, Louisiana's insurance commissioner had to sue State Farm because they hid behind a claim that they only had to pay out damages for properties that were within the pathway of the officially declared disaster. And the Hurricane Ida switched course last minute and hit New Orleans when it wasn't originally expected to. And so there were thousands of homeowners that had been paying premiums faithfully for years, expecting that if a hurricane hit their home, they would be covered by State Farm. And they actually lost that suit, and the Louisiana Insurance Commissioner failed to force State Farm to pay out those policies. We're also seeing insurance companies insurance commissioners start to respond to this by doing what they can to protect constituents. California has a law where the insurance commissioner is empowered to issue a moratorium against cancellations and withdrawals following certain disasters. But all that the law says is that the insurance commissioner plugs in zip codes that are within a certain radius of disasters and disasters that were declared by the governor. Well, last year, the insurance commissioner did this, and it affected 20% of the housing market in California. So that's just to give a sense of how major the wildfire problem is in California. So just as with policies related to ESG, we're seeing states move in sharply different directions here. On the left, I am showing that there have been some good climate risk policies adopted here and there. In 2011, the National Association of Insurance Commissioners began a survey that is voluntary for their state insurance commissioners to require insurers to comply with, that basically seeks climate risk disclosure from insurance companies. 15 states now use this survey. If you see your state on the list, great. If you don't, you should ask why not. New York and Connecticut last year, it was, so I should say since 2010, that's pretty much been the only game in town as far as climate risk and insurance policy are concerned. But then last year, New York and Connecticut, their respective insurance commissioners issued guidance that now expects insurance companies in those respective states to look at the balance sheet of their business and anticipate how they would respond to different scenarios and climate scenarios. So for instance, if the insurance company insures a lot of policies that are very vulnerable to sea level rise on Long Island in New York, they would have to anticipate what the implications are for the solvency and adjust their balance sheet accordingly. And this is thought to be a very consumer-friendly way of taking a tool that is used usually in bank regulation and applying it to the insurance context to ensure that insurance companies stop those denials, withdrawals, all those hazards that I mentioned in the last slide. Conversely, we're seeing in other climate risk exposed states sort of moving in an anti-consumer direction. Florida held 2 separate emergency sessions to deal with their property insurance meltdown. And they sort of claim that this is entirely because of frivolous lawsuits and not climate catastrophes. And in December, they passed an overhaul that did several things, but among others, it forced policyholders in the state-run reinsurance system, which is called Citizens, where there are 1.3 million Floridians who have an insurance policy that is covered by Citizens, to take a private insurance policy and leave Citizens if the private insurer can offer anything within 20% of the annual premium rate that they're currently paying. So in other words, if you are a very vulnerable coastal Floridian homeowner and you are currently paying $5,000 in an annual premium, and a private insurer comes along and says, I'll charge you $6,000 annually, you have to take that policy under Florida's new law. I think I'm running short on time, so I will just sort of mention that there are many different sort of next forays and options available to states that want to adopt consumer-friendly climate risk insurance policies. And I would love to talk to you about all of them. And I'll close by just saying that we sort of take the attitude that with respect to a lot of the backlash that we're seeing against climate financial regulation, the best defense is a good offense. And we've done message testing and polling on these subjects and confirmed that although voters may not understand what ESG is, they may not have a lot of information about climate as a financial risk. They strongly want their state and their pension fund and their budget to be integrated with the economic benefits of a just transition. And they certainly don't think it's fair to be paying exorbitant premiums every month or every year to their insurance companies and then have those insurance companies renege on that contract and end up not paying out damages when a climate disaster hurts their home. And so we know from evidence that voters want policymakers to protect them from climate chaos and protect them from the economic and financial risks that climate poses. And there's a whole range of policies, not just in insurance, but in other areas that we're working on and exploring. And I look forward to connecting with all of you about it. And I will turn it back over to Pete.
Thank you so much, Jordan. So appreciate this. When Jordan first reached out, I said, is there stuff states can do? And he outlined three big areas. One was insurance, one was green banks, one was pensions. And there's more than that, but those are the three we're going to focus on today. And, Jordan's given an overview of insurance and the question of green finance generally. If you have any questions, put them in the chat. We're out of time on Jordan's section, so he's going to have to answer those questions in the chat, but please drop them in the chat. And if we have time at the end, we might be able to throw some more questions back to Jordan. But we now want to move to the second topic, from insurance to this area of green banks and more. So let's throw it over to Brett.
Thank you, Pete, and thanks for having me. I'm going to go ahead and share my screen as well. Right. Hi, everyone. Make that big. Thanks for having me. My name is Brett, and I lead the climate policy strategy here in Boulder County. And I sort of began my work here at the same time that Biden signed the Inflation Reduction Act, and it was like, figure that out. And so we're doing a lot of work, as all local governments are at the moment, figuring out our approach to this new federal funding opportunity, how we scale our projects and meet our greenhouse gas reduction goals, which is mega to say the least. And one of the things that showed up on my screen in a big way was this greenhouse gas reduction fund, which I'm excited to talk to you all about today. That's one of like the many, many, many provisions in the Inflation Reduction Act. And it showed up because it's different. It's very different than the direct-to-consumer tax credits and grants and sort of like the one-off programs that expire. This is the long money and potentially has the ability to shift how we do climate finance for a long time. So yeah, I'll dive in here. I wanted to say that the way that we approach our approach to the Inflation Reduction Act in general is in these four categories. And that's sort of how I've been thinking about everything we're doing, but including our approach to the Greenhouse Gas Reduction Fund. So we're constantly considering our policy pathway. How do we add all the sticks to all of these carrots? And at what point do we sort of phase them in? The campaign work, so there is quite a bit of, well, the majority of the Inflation Reduction Act is direct-to-consumer tax credit and grants. How do we get people engaged? Like what's the education campaign to get people to take advantage of these programs? And then the advocacy work, and it's sort of pointed upward, both towards the state. We're communicating a lot with our the State Energy Office, who will administer the Homes and HERA Act, and I don't know, all the other parts, and then up to the agencies who, like the EPA and Department of Energy, who are dishing out some big funds. And then the fourth bit there, the big bear of implementation. What are like the actual projects that we're doing? So a quick, like super quick background on the Greenhouse Gas Reduction Fund, the Green Bank provision in the Inflation Reduction Act. It's a $27 billion provision that is a competitive grant to mobilizing financing for clean energy projects. And it's sort of broken down into these three sections, or kind of like two avenues. One of the avenues has two parts. So the first part is the $7 billion, and that is open to local governments, states, and tribes. And then the second and third part are the funds that go to eligible recipients, which are the financial institutions, nonprofit financial institutions that are funded by public or charitable contributions. And I'll talk a little bit about that later, but wanted to start with this first section, the $7 billion, which are targeted to local governments. We saw the issues therein. Okay, there's this $7 billion that's on the table. It's pretty wide open, and everyone should be applying to this, which creates a pretty big issue of just a significant number of applicants. And then maybe not everybody can apply because of the reporting requirements and who has staff to deal with that, and just the constant issue of capacity at local governments for climate action and electrification projects. And we recognize that the EPA is more likely to support funding structures that they're familiar with. And then, of course, the inequities of capacity for local governments, and more well-resourced local governments like Boulder County might step forward to apply for these funds, and there's inequities embedded there. So here's the proposal that I'm excited to share with you all, that hopefully sparks interest for your state. We are working with our state energy office and our state green bank, the Colorado Clean Energy Fund, to pull together as many local governments as we can across the state to discuss a single application for this $7 billion pot. And that's been really great. We're still in the process of like working through what that looks like. But essentially, here's where we are, that we believe this is going to be beneficial, and there's lots of buy-in. We think this is a structure that will be attractive to the EPA because it's familiar. It lends to more equitable distribution of capital. We can sort of like talk about how climate impacts cross local government borders and how we might project together. And it's a more efficient mobilization of the resources, and the heavy reporting requirements, and just whatever the administration of the financing can be sort of centralized where there is capacity at the green bank. And then also talking about developing sort of like a list of a menu of program offerings. so that local governments can just move forward with those, and it's doesn't need to be program development. So we're had some initial meetings working towards defining our single application for this $7 billion. And it's really strengthened the coordination with Colorado Energy Office and local governments in our Green Bank, which we are hoping sort of rolls into the other big part of the Greenhouse Gas Reduction Fund, the $20 billion that is financing, that local governments can work closer with our state Green Bank and help design and bring projects, which brings me to the paper that I think Pete mentioned earlier, and Jordan is an author on. So hope that there's lots of questions about this, but this is a great sort of North Star for states that are considering the formation of green banks or the evolution of their current green bank. We were really excited to work with Jordan and Harvard professor David Wood on what a green bank might look like today, given the fact that our like relatively small Colorado Green Bank is about to balloon in size, when I'm speaking about capital, because of the Inflation Reduction Act. And there should be lots of interest from local governments about what it looks like and our sort of democratic participation in this mega public bank. So I'm happy to share these slides at the end, and that is a link, or we can share the paper itself afterwards. But I hope folks have a chance to check that paper out. That's all I had. Thank you.
Thank you so much, Brett. And we have a little bit of time for questions, so please drop questions in the chat. We have one from Jack that says, in Minnesota, we are struggling with the question of public versus nonprofit green bank. What are the implications for the $20 billion pot?
Would love to pull Jordan in to help answer this question. I want to say that part of the paper that we published with Jordan and David was leaning on that question, that our Colorado State Green Bank is a nonprofit, and if it does balloon with mega federal funds, should the question of that nonprofit status be up for debate? Should there be a quasi-public or public bank because it's so much public money, or potentially some sort of more democratic governance structure where local governments, communities, tribes have more oversight and say? I don't think that there's implications for the $20 billion pot there in that division of nonprofit versus public. However, we don't know yet because the guidance isn't issued. Jordan, can I pull you in?
Yeah, I mean, I think until we have more clarity about the EPA's grant-making process, which should happen very soon, we won't know for sure whether states that qualify for that $7 billion will also be eligible to receive some portion of the $20 billion. But I would just say I'm in touch with some folks who are working on qualifying Minnesota for a green bank, and the approach that we outline in the paper is to make it a publicly accountable, publicly inclusive governance structure that has a lot of oversight from the state legislature, and to essentially make it quasi-public. You can structure it as a nonprofit or not, but I think the argument for how much money you are going to qualify from and which funds you're drawing from within the Greenhouse Gas Reduction Fund is an argument that we're going to be having another day. And so I wouldn't think of it as like, oh, if we make this a nonprofit, then it's only going to be eligible for one, but not the other. Just make it the strongest and most ambitious possible green bank, and that is what's going to attract the federal government to investing in it.
Yeah. Maybe one other detail that I think folks would love to hear is this provision in the law had a timeline on it, and the timeline was almost now. So the rumor, but not publicized detail, is that the EPA is going to issue the RFP on the 15th or thereabouts of this month. And then, of course, there's the 40 to 60 days to respond. And then I recognize that pulling together local governments or pulling together coalitions of any sort is a time-consuming process and project. However, there is time for your state to do the work of thinking about a single application for at least that $7 billion.
And as we have one more minute for questions, not seeing any more in the Q&A, I just have a quick one. From our understanding at DPN, and we see this a lot, there's a large federal pot, and a lot of times states and cities don't move fast enough to get access to this, and then it goes to the usual suspects who are not the most qualified to deploy that money in the way to serve the ends that we all care about. And what is the world where where's the money going if your state does not get a green bank plan in order to meet this? What is the alternative if we don't get this together? Either Brett or Jordan.
That's you, Jordan.
Oh, well, there's a lot of CDFIs, credit unions, and nonprofits that are going to be considered eligible recipients of the $27 billion or the $20 billion, and there some of them are in states that haven't, as a statewide matter, set up a green bank. So St. Lucie County, Florida, for example, has a program called SELF that actually originally stemmed from some stimulus money back in 2009. And this program is a nonprofit that does a lot of work helping low-income homeowners in St. Lucie County, Florida, install rooftop solar. And it isn't exactly a green bank, and it's certainly not done with the full purview of Florida state government in the way that we would recommend, but it is a nonprofit, is also a CDFI. It's part of the Treasury's CDFI fund, Community Development Financial Institution. And so it's probably going to get some money. And so whether you're in a state that has a green bank or not, you should look to existing programs. Many states have them regardless of the political context.
Thank you for that. We now move to our third section. We've talked about the aspects of insurance. We've talked about green finance and or green banks. And now we move on to pensions. So over to Natalia.
Thanks, Pete. And thank you all for being here to talk about this important topic. So I'm going to talk about protecting pensions from anti-ESG policies that Jordan started talking about in his presentation. And to give just a little bit of background, there are over 6,000 pensions investing the retirement savings of almost 26 million workers and retirees. And we're talking about between $5 and $10 trillion in assets under management. And pension funds are invested in a variety of different types of investments, including public equities, private equity, real estate, and fixed income investments. And they're governed by trustees that owe a fiduciary duty to the beneficiary. So there's a lot of talk about fiduciary duty in these anti-ESG wars that I'll talk about more later. Another thing to keep in mind is that many trustees are affiliated with labor unions, so they're key stakeholders in these types of policies. And they're major clients of BlackRock and State Street. And a lot of these ESG awards have to do with how much power certain asset managers have. So the industry is very concentrated, and three big asset managers, BlackRock, State Street, Vanguard, own over 20 trillion in assets, and they own about 20% of the average S&P 500 company, like cast about a quarter of votes. So they have, a lot of power in how public companies operate. And with pension funds being significant clients of theirs, there's also, a lot of power there. So what is even ESG? This is people have different conceptions of what ESG is, which is, ripe for taking advantage of that politically, a la CRT, I would argue, and many have. But to give the background, it's a term that was coined in a report by the United Nations and financial institutions that talked about better including ESG factors in investment decisions for different reasons: stronger and more resilient financial markets, sustainable development, improved trust in financial institutions, awareness of mutual understanding of involved stakeholders. Since then, again, there are a lot of different understandings. So factors for investment analysis, risk management, and corporate social responsibility and preference. So some people, I think, like the main divide really is, a lot of people talk about it, and that's the way I think, I'm going to talk about it, is that it's a tool for assessing like risk and opportunities. And there's like other people who talk about it more as a preference, like you may choose to invest in an ESG fund or, some investment that takes certain things into consideration because of your own personal preference. And to give a sense of how this is conceptualized by trustees and labor affiliated trustees, more specifically, they sent a letter recently to asset managers that talked about, what they mean when they say ESG, because it's a lot better to talk about what we're actually talking about as opposed to this acronym that can be confusing or ambiguous. So they talked about how, as fiduciaries themselves, they have to incorporate climate risk management and the consideration of climate-friendly energy opportunities. And they also feel like they have the obligation as fiduciaries to address the negative impact of structural racism. And they point to studies from the financial industry itself that indicate that trillions of dollars of economic value is just lost due to structural racism in the United States, and that there are other stats that talk about how much GDP could increase if structural racism was addressed. They also say as fiduciaries that they feel that they have to encourage the full integration of sustainable workforce policies and practices, including worker safety, health, adequate compensation, and rights on the job as key components of sustainable business practices, and demand healthy and robust corporate governance practices in public and private markets. So think Enron, or having a board that's actually independent, right, and not totally controlled by conflicts. So the ESG movement, I think, has been around, but it really sort of blew up last year. And I have some headlines that sort of illustrate the different ways it blew up. I think, as Jordan mentioned, it really is, fossil fuel financed, and a way to sort of attack the progress on climate finance that has been made. And they're just attempting to loop in other things and make it a culture war issue. They started introducing a lot of state level legislation last year that has, revamped significantly this year, and really big political figures, spoke out against it. There's, with the divided Congress now and opponents of ESG in charge of the House, like this is like a big issue that they're going to continue, highlighting through hearings. Even today, this came up in a hearing, and this will be just an issue that they continue to discuss, and also to try to block all the regulatory action that's being pushed forth by this administration. So we need to fight back against that. So a few key players. There's the State Financial Officers Foundation that has organized a lot of state financial officers to rally against ESG. ALEC, of course, has had a couple of model bills out that has obviously helped propel like all of these introductions throughout the country. Republican attorneys general have also been active, like sending letters saying like, we're concerned about ESG's antitrust implications, which are completely unfounded, making arguments about fiduciary duty that are also incorrect. And then I added here Strive Asset Management. That was founded by an ESG critic, saying that he's like providing an alternative to asset managers that take ESG into account, and he's kind of the antithesis of that and wants to use investments to push public companies to drill more, to forget about climate catastrophe and just focus on short-term returns. So those are some of the key players. There's two sort of main bills that have main types of bills that have been introduced. So one that has gotten a lot of attention has been on contracting. So the thrust of it is to bar state actors from contracting with banks and other financial institutions they deem to be quote unquote boycotting certain industries such as fossil fuel companies or gun manufacturing. Doesn't make a ton of sense because, it was like they targeted BlackRock, but BlackRock has a bunch of, has a huge investor in fossil fuels. But they passed in a few states listed here, and a few other versions have been introduced. A big headline was that there was a study that was conducted by an economist at the Fed and a professor at Wharton that found that actually the Texas law will cost Texans between $300 and $500 million in additional interest, basically because a lot of the banks that were the underwriters for municipal bonds left the market, so there was less competition, and now Texans are having to pay all this extra money. And there was a study that used the same methodology and found like all of these millions of dollars that it would cost taxpayers to if this policy were included. So for the ALEC board actually ultimately refused to endorse the bill, and I think there's just bank lobbyists hate it. There are a lot of powerful interest against it, so it's been I think like this will have a little less momentum than the one that really focuses on pensions, that tries to have different ways of saying like don't take into account quote unquote non-pecuniary factors, and they're trying to get at environmental, social, and governance factors that we're talking about. And I know there's a paper coming out soon that actually breaks down how this law is totally unworkable. So I'll make sure to share that resource with this group, like as soon as it's published. I believe it's supposed to be published this Friday. Wanted to sort of note also there's an event tomorrow at 2:30 with a bunch of major labor unions that are taking a stand against the ESG wars, and just I put here their language so you get a sense of what their position is on this. They're obviously fought really hard for pensions, and they don't appreciate people getting in the way of their retirement security. Just a couple of stats saying voters are on our side, which I'm not going to go through because I'm over time and have a bunch of other stuff that I'll try to go over quickly. So
you've got time. You got 5 more minutes.
Okay. Great. But I'll send the stats if voters think this is stupid and are on our side. So for alternative policies, so full disclosure, there's not like a perfectly tailor-made policy to send to all of you right now, but I do want to share different areas where you can consider developing policy, and just kind of want to emphasize that it's important to focus on consulting with key stakeholders, including treasurers, pension fund trustees, and labor groups they're affiliated with. So, you know, just like doing the coalition building ahead of time. And the reality is that state laws are different, pension policies are different, you know, so like where there might be space to push the envelope, like will vary by state. So one thing I wanted to mention, for example, on alternative policies are about asset manager accountability, and Brad Lander, the New York City Comptroller, has really been a leader here. So recently, for example, he filed shareholder resolutions with several of the major banks demanding that they set hard caps on what they finance that produces emissions in 2030. And he was like, BlackRock, I'm looking at you, like, as you know, as our asset manager, like, how are you going to vote? Like, we might sort of reconsider our relationship depending on what you do here. And earlier, he had sent a letter to BlackRock saying, like, we have all these net zero policies that we're implementing, you know, in our pension funds, because it's important for our pension funds financial security, and you as our, you know, and we as your client, like, we need you to make sure that you're actually doing what you say you're doing and you're not backtracking. So they had a bunch of demands: publishing an implementation plan that makes clear BlackRock's commitment to achieving net zero across its entire portfolio, with concrete steps detailing how it intends to reach science-based targets on a specific timeframe. You know, provide a detailed approach to keeping fossil fuel reserves in the ground and phasing out high emission assets. All to say, right, like, there's power there in pensions, like having the asset managers that work for them, right, like actually make sure that they're not like screwing over the pension assets they're managing for them. Another big thing is private equity. So between 1/3 and nearly half of all assets under management by private equity come from worker pensions. And while the public pushes for a transition to renewable energy, private equity firms are propping up the dirty energy industry by acquiring more and more fossil fuel assets. Some of my colleagues at AFR published this report that I'm happy to send out. And private equity is a pretty, has a lot of enemies. So, you know, a lot of climate folks for this reason, but also they have like very, in general, like predatory, a lot of them have really predatory business models that are about loading up companies with a lot of debt, trying to extract as much as possible, which means like worker layoffs, terrible things for consumers. They've like increasingly creeped up on healthcare with terrible outcomes for patients. So, you know, there's a lot of coalition building potential there on private equity disclosures and accountability. And then on this theme of private equity, I want to highlight a couple of recommendations. This is my last slide. A couple of recommendations from law professor David Weber, who like tells the story of pension funds that were invested in a private equity firm that invested in this company, Aramark, and a lot of their business model had to do with privatizing public services. So the public sector workers whose jobs this company was trying to privatize was actually funding this. And, you know, had detrimental effects. A lot of people got laid off who were like investors in this. So there's opportunity to change, to see what the law is in the state to make explicit that the economic interests of beneficiaries, like, you can take into consideration employer and employee contributions, and it's not just returns, because the person who made this investment decision was like, oh, like it was good for a return. So it's like, well, right, what about like employer and employee contributions? And then there are also like model policies that can be adopted, like responsible contractor policies requiring pensions to pay prevailing wages and benefits and infrastructure and real estate projects, and banning pensions from investing in privatization in general. So those are broad sort of areas where there's potential for policymaking. And I'll stop there because I'm way over time.
Thank you so much. If you have any questions for Natalia, drop them in the chat, and she can get back to it over these next few minutes. And for all three of our experts here, they're available to be contacted, and we can put you in touch with any of them to follow up on any of these questions. And in that spirit, we usually end these DPN conversations with a poll that's going to appear on the screen. And it's simply going to ask you one question. Do you want to join a green finance? Are you interested in championing green finance policies in the coming year? And do you want to be invited, be added to a list of people that want to be invited to future briefings, learn more about this? If there's updates from our three experts, they can send them to your offices. You'd be part of a group of people that kind of have quick access to sending out an email to get answers from these experts. You can give your answer on the screen. I'll give my answer on my screen to demonstrate, and that'll make sure that you stay in the loop. The video of this will be available on DPN's website by tomorrow. Special thanks to Mike Draskevich, who put this whole DPN conversation together, and special thanks to Jordan, Natalia, and Brett for being experts for a year, and especially a special thanks to all of you for coming out and championing these green finance policies in your neck of the woods. So hope everyone can keep up the good fight, stay in touch, and we're here to help.